Nvidia stock has gone from $40 to over $900 in the last 5 years. That's a 22.5 times increase. With a market cap of $2.3 trillion, will it continue to skyrocket, or is the bubble about to burst? Tune in and find out. All right, guys, a few things we need to understand about Nvidia. Number one, the massive size of Nvidia. Just to give you some perspective, Nvidia is larger than Meta. It's larger than JP Morgan. It's larger than Google. Okay, this is just bonkers. To give you another perspective, when you talk about GDP for countries, the market cap of Nvidia is larger than the gross domestic product, which is the value of all goods and services sold over a course of a year, then Canada, Mexico, Russia, South Korea, Australia, Spain, Indonesia, and Turkey. So when you think about it, its size is massive. So ultimately right now, Nvidia has just gone completely parabolic from a growth perspective. So is it overvalued? Is it undervalued? How much bigger can it get? Nvidia is not the type of stock that we could reasonably build a DCF model on. Building a DCF model is going to result in really high, unrealistic valuations. So I did 3 models for purposes of this video. I built one based on the 5-year averages, one on the 3-year averages, and then also one based on Wall Street consensus estimates. Now, what we're going to see is Wall Street has Nvidia approximately at its current fair value, around $900 per share. But the gap between the highest person on Wall Street and the lowest person on Wall Street is pretty massive. Now, first thing we're going to talk about in terms of the financial model is the balance sheet. 3 takeaways from the balance sheet. The company has tons of cash. It has about $26 billion in cash and cash equivalents. That's very impressive. Number 2, despite massive growth, the company has very low leverage, meaning very little debt. It's been reinvesting the bulk of its capital into the company so that it can grow even more. Also, it's had about a 2 times increase in retained earnings over the last 5 years, which is pretty remarkable. Here is the balance sheet of Nvidia. Again, the highlights here. The cash, massive, about $26 billion worth of cash. This is something that they've been stockpiling for years now. If you look at the debt, very low leverage. Despite the fact that the company's had massive growth, they're actually very conservative with their debt. They're not piling up on debt. They're taking the capital that they build and generate and reinvesting it back into the company. And also, as I mentioned, retained earnings has basically doubled in the last 5 years, which is also truly remarkable. Very conservative balance sheet, very good stuff to see. Hey guys, if you like what you're seeing here, please smash that like button. All right, the next thing that we have to discuss is the income statement. Revenue more than doubled in 2023, but cost did not increase at the same rate. This is called positive operating leverage. Their net interest income, due to the fact that their invested cash is actually generating more income than their debt is costing them. Number 3, they have incredible deferred tax assets and a low tax rate. Their tax rate last year was about 12%. It's projected to be like 12 to 15% on a going forward basis. Let's hop in the model and check it out. Okay, guys, so as I mentioned, massive increase in revenues. If you look at this year over year, you're talking about more than doubling, 2.3 times over the course of the last year is just insane. Their net interest positive, meaning their interest income is higher than their interest expense. Again, this is a function of the fact they have $26 billion in cash sitting there, only about $10 billion in debt. So they have net cash, more cash than debt, and that's a tremendous positive. Lastly, in spite of the fact that they had this massive growth, even though they paid $4 billion in taxes, that's actually very low on a relative basis. When you look at the tax rate, it only comes out to about 12%, which means despite all this growth and all these amazing things that they're doing, they do have tax credits and they're generating more tax credits. So they're going to be able to still pay a very low tax rate on a going forward basis. All right, the next statement that we're going to talk about is the cash flow statement. This is the most important of the 3 financial statements. So some of the things that we want to focus on here, number 1, they've had a 5 times increase in operating cash flow year over year, driven primarily by net income. Also, over the last 2 years, even though the stock has been ripping, they have repurchased $19.6 billion in shares. Now, while I don't think that's a good idea now, the shareholders have benefited from buying those shares at those lower prices as the stock has continued to rip. Also, we've seen a massive increase in free cash flow. So what is the big takeaway here? What I want you to focus on is looking at the projections based on the 5-year averages. Cash is going to be 44 times larger in 2028 than it is today, which is just mind-boggling. Also, I would anticipate that they're going to have more capital expenditures on a going forward basis so that they could redeploy that cash, as well as potential acquisitions that they could make and take advantage of this huge cash hoard that they have. Let's hop into the model. So a few key pointers here. If we look at the net income, it has just increased massively. You're talking about 29.8 billion versus 4.4 billion last year. That's a 6.8x increase, which is just truly remarkable. If we look at cash from operations or operating cash flow, that's had about a 5 times increase. But in spite of that, they still have very low capital expenditures. So remember, a proxy for free cash flow is operating cash flow minus capital expenditures. And you can see based on that, they had about 1.9 billion in free cash flow 2 years ago and 27 billion last year. It's a 14x increase, which is truly remarkable. I also mentioned the share repurchases. So if we look right here, we see about 19.6 billion in share repurchases. All you have to do is look back at where the stock was a couple of years ago. They're buying back shares at those lower prices. All that's going to do is benefit shareholders in the long run. And then lastly, if I go down, what you'll see is a massive increase in cash. You see the closing cash balance projected for 2028 is $320.86 billion. That is just mind-numbing. So as I mentioned, I think they're going to end up redeploying that capital. They're going to increase capital expenditures, probably hire more employees, and I think they're going to make some acquisitions as well. The next thing that we have to talk about, DCF assumptions, or discounted cash flow assumptions. More specifically, what are we going to be using as a discount rate? Now they have a very high beta, which means a lot of volatility. The stock has 40x'd over the last 5 years, which is the measurement time frame for beta. So therefore, they've had a massive increase in beta and volatility in that time frame. So that's going to result in a much higher weighted average cost of capital. If there's a higher discount rate, that means that those future cash flows are going to be worth less in today's dollar terms. Another thing to notice, very low leverage. Less than 1% of their current capital structure is debt. Also, of the debt that they do have, they have incredibly high credit rating, A+, no joke. Lastly, one of the things we have to remember is with conservative assumptions, we're going to get conservative results. So with a higher weighted average cost of capital, we should ultimately get a lower, more conservative valuation. All right, guys, as we focus on the DCF assumptions, a few things that I want you to notice. The risk-free rate is the 5-year risk-free rate because we have a 5-year model. The beta, again, is fairly high. Most of the resources that I looked at had about 1.73, which stands to reason because the stock has gone up 22.5 times over the last 5 years. Equity market risk premium, we got that from Demoterin, 4.18%. Cost of equity comes out to 11.79%. We therefore look at the pre-tax cost of debt, which is what we're going to have to use if we were to get more debt. If we were to get more debt, what would we pay on that debt? Well, the determination is 5.01%, and that's because we have a spread of 0.92 on top of the risk-free rate. Effective tax rate, using the marginal tax rate in the US, 21%, we get 3.96. Super low leverage, so there's going to be a lot more weight given towards the equity. We end up getting a weighted average cost of capital, or a discount rate, of 11.75%. One other thing to notice here, they do have stock options that are in the money, which means the strike price is below the current price. So they actually have issuance of 26.9 million shares that's not currently captured in the basic shares outstanding. So we ended up adding that in here. That gives us a market capitalization of $2.274 trillion, book value of debt 9.7 billion, and then we have a total capital of 2.283. So that is going to be the basis of the breakdown of equity and debt. If we look down at cash and cash equivalents, as I mentioned earlier, we take the actual cash on hand, that's 7.3 billion, plus the marketable securities that they have of 18.7 billion. We basically have about 26 billion of cash. Now, one final thing to focus on before we actually get into the valuation here, terminal EBITDA multiple. Remember previously when I built other models, you could check out the Starbucks model or the Tesla model. One of the things that I talk about is the terminal value. That is going to be the bulk of the value of any DCF model.
Terminal value is the value from here all the way out to infinity.
with you. Now, one of the challenges is because we've had such high growth with a company like Nvidia, it has a super high multiple right now. It's actually 60 times EBITDA, which is just completely bananas. But I looked at the consensus estimates on Wall Street via Capital IQ, and what I got was an NTM, or next 12 months EBITDA multiple, of 30 times. That's going to give us a much better, much more conservative answer. So that's what I went with there. Now, here is the challenge with Nvidia, and I've said this numerous times. We cannot do a DCF in a traditional fashion because the averages are coming down. So if we use the 5-year average, those original averages are lower and pull the valuation down, but the 3-year average, those numbers are bananas. So that actually results in a significantly higher valuation. The company can't growing at like a rate of double. It's going to get way too big, way too fast. And Wall Street consensus actually factors this in. Wall Street consensus has a very high increase, steep increase in growth for next year, and then it levels off over time. But here's the challenge with that, guys. We have massive uncertainty. Even with Wall Street coming down, who knows when that will happen or how much it will be. And that is evidenced by the fact that the lowest estimate for the stock price for Nvidia on Wall Street is $600 per share. The highest, $1,400 per share. But if we take the consensus estimates, which basically takes the average of all of the Wall Street analysts, what we basically get is fair value. Let's check it out. So one of the things that I want to show you is the difference in revenues, particularly projected revenues, when you look at the 5-year average, 3-year average, and Wall Street consensus. So we ultimately have the lowest starting numbers with the 5-year average. That's because those early years end up pulling the numbers down. We have the next highest with the 3-year average, and we have the highest with the Wall Street consensus. But if we look closely, the Wall Street consensus is only higher for a very short period of time. And when we continue with these averages, look at these numbers in the out years. They're crazy. So the 3-year average, we get 690 billion in revenues in 2028. Wall Street consensus is about 185.5. And even the 5-year average, we're getting like 2 times what the Wall Street numbers are. So the punchline is we can't build a model off of the 3 and 5-year average. Wall Street consensus, even though that is better, it's still not going to give us a high level of certainty because we don't know when those numbers are going to come down. Hey guys, if you're enjoying this analysis, please smash that like button. All right, so the next thing we look at is the EBITDA. We see the same trends here. We see that Wall Street ends up having higher numbers in the first couple of years, but then in the out years, we have a massive outpacing of the numbers with the 3 and 5-year averages. And ultimately, Wall Street ends up having a significantly higher margin. But the issue is because the revenue growth is so much higher with the 3 and 5-year averages over that time frame, you get a significantly higher EBITDA as a result. Okay, last but not least, net income. Same trend that we saw previously. The Wall Street numbers end up being higher in the first couple of years, but in the out years, the 3 and 5-year average are massively, massively higher. So we got 1.4 times higher in the 5-year average case, 2.5 times higher in the 3-year average case. Again, the punchline is just using traditional metrics and methodologies, 3 and 5-year average, you're going to get really, really high, really crazy results. All right, guys, the moment that we've all been waiting for. What does this mean in terms of the valuation? So we end up getting the highest valuation using the 3-year averages for Nvidia and applying them into our model. We get a value of about $2,100 per share, which I know is crazy compared to the current share price. So that ends up being a discount of 132.4%, meaning you're going to more than double your money based on the 3-year averages. The 5-year average, we still get a value of $1,150, which is significantly higher than today's value of $900. We get a 27.7% discount, which again would still be a buy. But the very interesting one is when we put in the Wall Street numbers. When we put in the Wall Street numbers, we get a value of about $914 per share versus today's current value of $900. So what does that mean? That means Wall Street consensus estimates actually give us right around where it's currently trading. So it's currently trading at approximately fair value based on Wall Street consensus. Now that's very important to understand because we used the Wall Street consensus. We didn't use the high numbers, we didn't use the low numbers, we used the consensus, which is the average, and we got a value of $914 per share approximately. Now, what does that mean? Does that mean you shouldn't buy it, you should buy it, etc.? Well, based on Wall Street consensus, it doesn't make sense to buy it. That being said, Wall Street has a range of 600 to 1400. So that means you could have an upside of 56% or a downside of 33%. So you have to be very careful with this one. All right, guys, so what's the takeaway here? Wall Street consensus estimates we get a value of about $914 per share, which says it's 1.5% undervalued. The Wall Street range, though, is an upside of 1400 versus a downside of 600. So you either have 56% upside or 33% downside. That's a pretty wide gap. So what is one to do? Now, personally, I'm not invested in Nvidia, and based on this analysis, I'm not incentivized to invest in Nvidia. I do have exposure, though, via the S&P 500, and this is something that I've talked about previously. Now, the Magnificent Seven big tech stocks are about 32% of the S&P 500. So now, if you want exposure to Nvidia and other big tech stocks, you can get that exposure via the S&P 500 ETF, which would be VOO, would be just one example, the S&P Vanguard ETF. Now, here's the other interesting thing. This is a very competitive space. We're talking about AI, chips, a lot of moving parts, a lot of changing stuff. You might be better able to find value amongst the competitors. Now, the company lists out their competitors in their 10K, and some of the names include Alibaba, Alphabet, Amazon,
Ambarella, AMD, Arista Networks, Baidu, Broadcom, Cisco, Hewlett-Packard, Intel, Lumentum, Marvell Technology, Microsoft, Qualcomm, Renesas Electronics Corp,
Samsung, and Tesla. So those are some alternatives to investing in Nvidia. Those are some of their biggest competitors. If you like this and want to see another tech valuation, check out my Tesla model, which you can find right here. And if you found this valuable, please share this with someone who you think will enjoy this. And as always, be relentless.